Welcome back to Fundamentals of ABM 1. We're still studying Basic Accounting 1. Content Standards. The learners demonstrate an understanding of the accounting cycle of a service business. Performance Standards. The learner shall be able to identify business and non-business transactions, enumerate the types of business documents, recite the rules of debit and credit, and apply these to simple cases. Learning competencies. The learner shall be able to describe the nature of transactions in a service business, analyze and solve simple problems of business transactions, journalize transactions of a service business, post transactions in the ledger, prepare a trial balance, and prepare adjusting entries. Now we're going to start discussing the analysis of business transactions as applied to the accounting cycle of a service business. When you say it's a service business, that means that the enterprise is involved with activities such as consulting, accounting, or repair. This type of enterprises are part of a service business. First, we tackle the accounting cycle, and the accounting cycle is composed of 8 steps. The first one is journalizing. In journalizing, we journalize the economic transactions and events in the general journal and the special journals based on the source documents that we get. We put the account to be debited and also the account to be credited to make a journal entry. The second step is posting. We post the journal entries that we have entered in our journals and transfer them to the general ledger. The third one is the trial balance. We prepare the trial balance from the amount or balances that we get from the ledger. Adjusting is the fourth one, is when we adjust the ledger balances. Fifth is financial statements. We make the income statement and also the balance sheet based on the adjusted trial balance. Sixth step is closing. We close or transfer the income and expense accounts to income and expense summary account, and then the latter account will be transferred to the owner's equity account. Post-closing trial balance, we make a trial balance of all assets, liabilities, and owner's equity to prepare for the next accounting period. And then the 8th is reversing. So we reverse some adjusting entries, which is also part of our preparation for the new accounting period. Now, the steps in the accounting cycle are done within one accounting period. When you say it's an accounting period, it is usually a period of time that is around 1 year. 1 year. Generally, this accounting period starts from January 1st and ends on December 31st. If it is from January 1st to December 31st, we call it the calendar year. But there is also another period of 12 months, but it starts and ends on a date other than December 31st. If the end date is not December 31st, then we call it a fiscal year. Again, January 1st to December 31st, we call that calendar year. If the end date is not December 31st, we call it fiscal year. Now, in the performance of the steps in the accounting cycle, the accountant is guided by the company's accounting policies. These accounting policies are specific principles, bases, conventions, or probably rules and practices adopted by an enterprise in preparing and presenting financial statements. In a service business, the supporting documents are practically the same as with other types of business. In the previous video, in the previous lessons, we have already discussed about the different business documents. Now this is the diagram of the accounting cycle. We start with the source documents. These source documents are proofs or pieces of evidence of transactions. It could be if there is cash receipt, then the business would issue an official receipt, and that would be a source document. We also have like the sales invoice, we have the purchase invoice, we have the cash voucher, and some other source documents. So from these source documents, we get the information, and then we record them or these transactions for the first time in the general journal and other special journals. That's why we call the general journal as the book of original entries, because this is where we record the entries for the first time. Now, the journal entries are then summarized in the general ledgers, and now the general ledgers is are called the books of final entries. Once the general ledger accounts have been summarized, they are transferred to the worksheet together with the debit and credit balances. So say for example, there's account title cash, and then the balance of cash is, let's say, 100,000 on the debit side. Then you put it here, cash for 100,000, and then you write down all the other account titles and also write their balances. Now, adjustments of ledger balances are posted in the second set of money columns. So the first trial balance came from the balances from the ledger, right? And then you make adjustments to correct the amount of some account titles. There might have been some transactions that were recorded wrong, or probably there were some transactions that are not yet recorded, so we put these in the adjustments, and that would be the second set of columns. The net amounts of the first 4 columns are extended to the adjusted trial balance columns. So from this trial balance, this first, second, third, and fourth column, their net amounts will be written here in the adjusted trial balance. Now, the income statement account balances and balance sheet account balances are extended to the last 4 money columns. If the account title would go to the income statement, then they will be transferred here, extended here. But if the account title is included in the balance sheet, then the amount would be extended to the balance sheet column. Now, the completed worksheet helps in the preparation of the financial statements. We prepare the income statement, or we can also call this as the statement of results of operation. We also prepare the statement of owner's equity, and we also prepare the balance sheet, which is also called as the statement of financial position. Now let's start with step 1, journalizing. To illustrate the steps in the accounting cycle, there's a need to start with a list of account titles we call chart of accounts. So for this, for the sake of this discussion, I have prepared here a chart of account. So in the previous lessons, we already talked about what a chart of account contain. So say for example, the name of the company is Paul Lab Company, and then this is the chart of accounts. These are divided into different categories. You have your assets, and the assets are separated into current assets and also property, plant, and equipment. The chart of accounts again will be different for every businesses. You have here the liabilities accounts, the owner's equity accounts, you have the revenue or income accounts, and also the operating expenses. Since we're studying service businesses, our revenue account is only service income. Now, the number assigned in here also depends on the business. So the business enterprise is the one that decides what account number they would assign for each account title. So as you can see in here, the pattern would be for current assets, it would be all 1. They start with 1, and then for liabilities 2, for owner's equity 3, for revenue accounts 4, and then for for expenses account we use 5. This gives way for the addition of other accounts. So if you have like If you want to add other expense accounts, then you can add 519, 520, like this. So we start with the chart of accounts, the listing of account titles called chart of accounts. The account names listed again are determined by the head of accounting or by a systems analyst who designed the accounting system at the start of the business. Now let's have some demonstration of the journalization. Let's look at how transactions affect the accounting equation, just like what we studied in the previous lessons. So for assets, an increase in asset is recorded as a debit, a decrease in asset is a credit. If it is a liability, if there's a decrease in liability, we put it on debit, and then if there's an increase in the liability, it's on the credit side. For owner's equity accounts, if there's the decrease, if the effect is a decrease in owner's equity, we put it on the debit side, and if there's an increase in the owner's equity, we put it on the credit side. For the income accounts, just like service revenue or service income, if there's a decrease in the income, we put it on the debit side, and if there's an increase in the income, we put it on the credit side. For expense accounts, if there's an increase in expense, we put it on the debit side, and if there's a decrease on expense, we put it on the credit side. As you can see in here, an increase in asset and an increase in expense is recorded on the debit side, and then a decrease in liability, decrease in owner's equity, and decrease on the income are recorded on the debit side. Okay, now we'll try to discuss this one by one as we go over the different transactions that we have in here. Let's look at the first transaction. December 1st, S.E. Reyes invested $500,000 to start JJJR Printing Services. So you don't really have to memorize the account titles that you have to enter in the journal entry as a journal entry, but you just have to understand how each transaction affects the asset, liabilities, and owner's equity accounts. So in this case, S.E. Reyes invested $500,000 to start JJJR Printing Service. If S.E. Reyes invested $500,000 in the business, that means the business received cash of $500,000. But of course, we start with the date. This is December 1st. So the first column is date, then we record it as December 1. And then since we or the business received $500,000 in cash, and cash is an asset. If the business received $500,000 in cash, that means the asset increased. So we record it on the debit side. So we debit the account title cash in bank. We debit cash in bank because we received $500,000 of cash, and it is an asset, and it increased the cash. It increased the asset. So it is on the debit side. Now the amount is $500,000, so you put it under the debit column. So that's $500,000. Cash in bank for $500,000. The account title that we will use here will depend on the chart of accounts. So if you remember in here, our cash account is cash in bank. In some chart of accounts, there is cash in hand, cash in bank, categorized separately. But in this case, we're using only cash in bank. Now, going back, since we received cash in bank or cash for $500,000 and it was invested by S.E. Reyes, that means that S.E. Reyes will have an ownership in the business amounting to $500,000. So S.E. Reyes capital will be recorded. It's S.E. Reyes capital because we put it on the credit side, because an increase in the owner's equity account is credited. So there's an increase in the ownership of SE Reyes. That's why it is credited, and the amount is 500,000. So we debit cash in bank for 500,000, and then we credit SE Reyes capital for 500,000. And of course, we should not forget the short explanation for the transaction, and that is initial investment. What if SE Reyes invested laboratory equipment worth 350,000 to start JJR business instead of investing cash? Since what we received was not cash but laboratory equipment, and laboratory equipment is an asset, and if we received it as a business, it increases our asset, so we put it on the debit account as a debit entry. And our account title based on our chart of account would be here. So we have an account title laboratory equipment, so we debit laboratory equipment for 350,000, and then we credit SE Reyes capital for 350,000. Why didn't we put any cash in the entry? Because we didn't receive any cash. Instead of cash, laboratory equipment was invested, so we debit laboratory equipment. What if SE Reyes invested cash and office equipment worth 200,000 pesos and 150,000 pesos respectively to start JJR services? In this case, the business received cash and also office equipment. Since we received cash, cash is an asset and it increased our asset, so we debit cash in bank for 200,000, and then we also debit office equipment because we also received office equipment, and office equipment is an asset and it increased our asset, so we put it on debit, so office equipment amounting to 150,000. And the total is the amount of ownership of SE Reyes, so that's SE Reyes capital for 350,000. Now let's analyze this transaction. December 2, SE Reyes withdrew 30,000 from the business. If SE Reyes withdrew this, that means that her ownership in the business decreased, and a decrease in owner's equity account is a debit entry. So we debit SE Reyes drawing for 30,000 pesos. If you're going to take a look at the chart of accounts, the owner's equity accounts would be SE Reyes capital, SE Reyes drawings, income and expense summary. An investment would mean an entry for the account title SE Reyes capital, and withdrawal would mean the use of the SE Reyes drawings account. So in this case, we debit SE Reyes drawing for 30,000. And then what did the business give? The business gave out cash to SE Reyes because SE Reyes withdrew. So our cash decreased. And cash is an asset, and a decrease in asset is on the credit, is a credit entry. So we credit cash in bank for 30,000. And our short explanation is cash drawings. So again, the entry would be December 2nd, debit on SE Reyes drawing for 30,000, credit cash in bank for 30,000, and the explanation is cash drawings. Next transaction, December 3rd, total cash receipts from services rendered amounted to 45,000. Total cash receipts from services. The business received cash. Cash is an asset, and if the business received cash, that means the asset increased, and that means that we have to put it as a debit entry. So we debit cash in bank for 45,000. We got this cash because we rendered service. That means we earned income. So an increase in income is credit, is on the credit side. So we credit service income for the same amount, 45,000. And whenever we render services, when the business renders service, then the business would issue a charge slip, and this one, let's say, is charge slip number 001. Okay, so that is on the explanation. Next transaction, December 4th. Total charge services amounted to 8,000. That means that the business rendered service, but the customer hasn't paid yet. So you call it as a charge service. So the charge service has a total of 8,000. If we have rendered service but we haven't received the payment yet, then that means we have accounts receivable. We have amount to be collected from the customer. An accounts receivable is an asset, and if the charge service hasn't been paid, then there's an increase in the accounts receivable. So we put it on the debit side. So we debit accounts receivable for 8,000. And then again, we have this because we rendered service, so we earned income by rendering service. So increase in income would be credit entry. So we credit service income for the same amount, 8,000. Next, December 5th, the receivable from December 4th was collected in full. If you remember, we have here accounts receivable for 8,000 on December 4th. And on the next day, it was collected in full. So if we debited accounts receivable here, then when it is paid, we put it on the credit side. So on December 5th, we credit accounts receivable because it has been paid. It was collected in full. If we collect it, that means the business received cash. So if we receive cash, that increases our asset, and we put it as a debit entry. So we debit cash in bank for 8,000 and we credit accounts receivable for 8,000. Next, December 6, paid municipal license for 2,000, issued check number 001. Businesses usually pay using check or other means, but in this case, a check was issued and the check number is 001 and the amount is 2,000. If we paid cash, we issued check, that means our cash decreased. And a decrease in cash or a decrease in asset is recorded as a credit entry. So we credit cash in bank. But what did we pay for? We paid for municipal license. And if we're going to take a look at the expense account, we have here taxes and licenses. So we paid for municipal license, then we can use taxes and licenses. An increase in the expense is recorded as a debit entry. So we debit taxes and licenses for 2,000 and then we credit cash in bank for 2,000. Taxes and licenses is debit because it's an increase in expense. Cash in bank is credited because that's a decrease in cash, a decrease in asset. Next, December 7. Paid check 002 for payroll for November amounting to 16,000. The business paid, a check was issued. That means that our cash decreased. And we paid for the payroll. And payroll is an expense. If you're going to take a look at the expense accounts, we have in here salaries and wages for the payroll. So an increase in the expense is debit. So we debit salaries and wages for 16,000 and then we credit cash in bank for 16,000. This is a credit because we paid, because our cash decreased and cash is an asset. So a decrease in asset is recorded on the credit side. So we credit cash in bank for 16,000. Next, December 8, paid 2-month deposit and 1-month advance rent. Monthly rent is 12,000, issued check 003. So the payment was for 2-month deposit, 1-month advance. If every month is for 12,000, then the total amount on the check is 12,000 multiplied by 3. That's 2 plus 1. So 12,000 multiplied by 3 is 36,000. 2-month deposit, let's look at the chart of account. So we have here rental deposit. It is an asset. And then the other one is 1 month advance rent. So we record it as an expense. And let's see, we have here rent expense. And this is operating expense. It's an expense account. Let's look at the transaction. 2 month deposit, rental deposit is an asset. The rental deposit increased, so it's debit. So we debit rental deposit for 24,000. Why is it 24? Because for 2 months. 1 month is 12 multiplied by 2, 24. Now, 1 month advance rent is an expense. An increase in expense is debit. So we debit rent expense for 12,000. Now, the total cash issued or disbursed is the total of rental deposit and rent expense combined. So the cash in bank decreased by 36,000. So we credit this account title.